We build machine learning models, but why do most of them never reach real users? The answer is MLOps. This book is written by Mark Trevell and the Dataiku team, and it focuses on one big question. That big question is, how do we scale machine learning in real companies? So, what is MLOps? MLOps stands for Machine Learning Operation. It is the bridge between building a model and running it reliably in the real world. It combines machine learning, software engineering, and DevOps. So, I will tell you what I will explain in this series. This book is divided into multiple parts, but I will focus on part 3, MLOps real world example, and in particular chapter 9, MLOps in practice, consumer credit risk management. Why it matters? This chapter explains how machine learning is used in credit risk management. For example, should a bank approve a loan or not? Is a customer is financially stable or unsafe? How do models behave after deployment? And most importantly, how MLOps keeps these models accurate, fair, and reliable over time. In consumer credit risk management, machine learning predicts whether a loan will be repaid. Scores are used at pre-screening, underwriting, and post-approval stages because wrong predictions impact both banks and people. These models are tightly regulated. Defining bad outcomes is complex. So, early risk indicators are used instead of waiting for full defaults. This structured, monitored approach makes credit risk a real world precursor to MLOps. Credit risk models have existed for decades. For example, FICO scores. FICO is an abbreviation of Fair Isaac Corporation, which is developed in mid 90s. It is widely used by banks. The FICO score is a credit risk score that predicts how likely a borrower is to repay a loan. Because these models directly impact both bank revenue and customers' lives, they operate in a highly regulated environment. This makes consumer credit risk management a precursor to modern MLOps. Earlier, banks used simple rules and basic math models to decide loans. Experts manually decided which customer details were important. They spent a lot of time creating features, grouping customers, and checking how different factors affected risk. Because money and risk were involved, these models followed strict rules and needed expert validation. Later, machine learning models made this work faster and more accurate with less manual effort. But since these models are hard to understand, banks now focus on explaining, validating, and monitoring them, which is exactly what MLOps is about. Here are the technical challenges of model bias or key consideration of model bias. When banks reject loan applications, they only collect data from approved customers. This means the training data slowly becomes biased. Second point, if a new model is trained only on approved customers, it never learns about rejected ones. So it performs poorly exactly where it matters most. Point 3, bias correlation methods. To fix this, banks use techniques like reweighting data or adding external data. This helps represent all applicants, not just approved ones. Point 4, need for probabilities. Credit risk models should predict how risky a customer is, not just approve or reject. This requires accurate probability estimates. Point 5, probability calibration. Raw model probabilities are often inaccurate. So banks calibrate models to make prediction match real historical outcomes. Point 6, subgroup validation. Models are tested not only overall but also for different customer groups. This ensures fair and consistent performance. Real world impact. Ignoring bias can cause serious damage. For example, the Apple credit card faced criticism in 2019 for gender bias. You can go and search it over the internet or browser. You will find that. Prepare for production. Strict validation is needed because credit risk models affect money and people lives. They must be careful validated before going to production. Full documentation is also a better point to consider. Banks fully document the data used, how the model was built, how it was validated, and how it will be monitored. Two types of monitoring are there. After deployment, models are monitored in two ways: data drift and performance drift. Why data drift matters? Loan outcomes take months or years. So, waiting only for performance result is not enough. That's why data drift must be tracked early. Charging world problem. If the economy changes or business politics change, the type of applicants also changes and the model may stop working correctly. Drift metrics by segment. Drift is measured using statistical and financial metrics, often separately for different customer groups. Independent model review. An independent risk team reviews the model to make sure the right questions were asked and nothing was missed. Rebuilding the model. In critical cases, the validation team may rebuild the model from scratch using different tools to check reliability. Impact on MLOps speed. Because validation is complex and slow, quick fixes are not possible, leading to slow but safe MLOps life cycle. Model deployment to production. In large banks, models are built in one environment and deployed in a completely separate production system. Production systems change very slowly because they handle critical financial operation. Historically, these systems mainly supported simple rules and models like logistic regression, simple machine learning algorithms. Advanced machine learning models are harder to deploy in critical systems due to stability and risk concerns. For less critical applications, banks may use modern tools like Docker or ML platforms. Deploying a model can be simple as clicking button or as manual as rewriting logic from documentation. Importance of logging is once deployed, every model action must be logged So performance can be tracked. If monitoring happens rarely, it can be manual. If it happens often, automation becomes necessary. For short-term loans reviewed weekly, automated monitoring is very essential. So that's all for this ninth chapter. See you in another video.